Hello everybody, welcome back to Options Made Simple. Today we'll be talking about credit spreads and we're going to run through some credit spread scenarios. If you haven't seen my previous video on debit spreads, I would suggest you watch that one first before this one. I'll put the link to that video in the description. If you recall, a debit spread is a spread that you buy, so a credit spread is a spread that you sell. The reason why we call it a credit spread is because you receive premium for selling that spread. Unlike a debit spread where the maximum profit depends on how wide your strikes are and the amount that you paid for the spread, with a credit spread, your maximum profit is based on how much you're able to sell that spread for. Make a mental note that selling a spread puts you on the opposite end of the trade of the person who bought the spread. A person who buys a call spread is bullish on the stock, so that means the person who sold a call spread is bearish on the stock. And for puts, a person who buys a put spread is bearish on the stock, so if you sell a put spread, that puts you in a bullish position for the stock. To really drive this home, we'll use a Microvision spread as an example. We'll say that Billy is bullish on Microvision, so he buys a call debit spread with the strikes of $18 and $22. After evaluating the bid-ask for the two different strikes, he enters in a bid of $2.45 for the spread. You decide to go ahead and sell him that spread for $2.45 because you're bearish on Microvision and believe that the price is going to drop. Let's evaluate what happened. Billy put in an order to buy the $18 call and sell the $22 call. You filled his order by selling him the $18 call and buying the $22 call. For this transaction, you collected $245. Your maximum profit for the trade is a credit you received for selling the spread, which was $2.45. Your max loss is found by subtracting the premium you received from the width of the spreads. You collected a credit of $2.45 on the spread that is $4 wide, so your maximum loss would be $1.55. To find your break even, you would add the premium you received from the strike you sold. Since you sold the $18 call, you would add the $2.45 credit to $18, which would give you a break-even of $20.45. To find the break-even on a put credit spread, you would subtract the premium you received from the strike you sold. Billy, who is on the other side of your trade, would have the complete opposite profit and loss. Since you sold him the spread for $2.45, his maximum loss would be $245, while his maximum gain would be your maximum loss of $1.55 or $155. Credit spreads are very useful when you want to sell options while limiting your risk. Since you're buying an option that is further out the money than the option you're selling, it caps your losses if your strike price were to get breached. For example, if you sell a $60 call for $3.85, since the call is uncovered, you face a unlimited loss potential if the price of the stock were to blast through the $60 strike that you sold. Instead, if you sold the $60 call for $3.85 and bought the $70 call for 92 cents, your upside is now protected and your losses have a cap if the price were to rise significantly above $60. To calculate your max profit, you would subtract the premium you paid for buying the $70 call from the premium received for the $60 call. This would leave you with a maximum profit potential of $2.93. Your max loss would be calculated by subtracting the premium you received from the width of the strikes. 10 minus $2.93, so your maximum loss would be $7.07, and your break even is $62.93. Let's compare the trades. By selling the naked call, your maximum profit potential would have been $385 and you would have unlimited loss potential. By selling the credit spread, your maximum profit potential would have been reduced to $293, but also your maximum loss is defined at $707. In theory, you could have sold two credit spreads, collected $586 in premium, and your maximum loss would have been $1,414, which is still taking on much less risk for selling a call while receiving more premium. We'll end this bit by talking about what options you have if your strikes get breached on a put credit spread. Unfortunately, if a call credit spread goes wrong for you, then you're basically fucked, but that's not always the case for puts. We'll say you sold a 15/20 put credit spread for a premium of $2.40. This was achieved by selling the $20 put and buying the $15 put. Your max profit is $2.40. Your maximum loss would be $2.60. And your break even for the spread is $17.60. Let's say at the contract's expiration, the stock was trading at $14, which is well below your break-even price of $17.60. If you let the spread expire, you lose $260, and that's the end of the story. Although, you have another option if you feel as if this dip was unjustified and thought that the stock was going to rebound. So keep in mind that as your $20 put you sold was losing money, the $15 put you bought was gaining money. At the end of the trading day, or at any time really, you could sell the $15 put at a profit, which would leave you with the naked $20 put that you sold. At the contract's expiration, you would get assigned the shares for $20 a share. Although your overall cost basis for the shares depends on how much you were able to sell your long leg for, but regardless, it would be less than $20 a share. You could hold on to the shares waiting for a rebound, or even sell covered calls against them to run the wheel. Keep in mind, since your $20 put no longer has a cap, you just dramatically increased your risk and maximum loss potential on the trade, but you also have the benefit of owning equity in the company, which you would not have had if you let the spread expire. The last thing I'll add is that if you let your put spread expire in between the strikes, you're going to be assigned shares from the company. This is because your short leg is in the money and will be exercised while your long leg is out the money and will expire worthless. Since assignment happens during after hours, if the stock were to continue to significantly drop in price during after hours or pre-market, your loss has the potential to be much greater than it was when it was defined by the spread. So always keep an eye on your spreads close to expiration and close them manually if you do not want to take assignment, because you never know what can happen. That's all I have for you guys today. If you have any questions, feel free to post it in the comments, and we'll see you next time.